All right, let's talk about investing. I know, for a lot of people, that word can sound pretty intimidating, right? It's like it's wrapped up in all this complicated jargon. But honestly, at its core, investing is one of the most powerful tools you have to build real wealth and actually hit your financial goals. So today, that's what we're going to do. We're going to demystify it together. And you know what? We're going to kick things off by tackling the single biggest, most expensive mistake that new investors make. Seriously, getting this one thing right from the start, can change absolutely everything for you. So, what do you think it is? What's that one big blunder? Is it, buying a stock right before it tanks? Or maybe missing out on the next Amazon? It's a really important question. Well, here's the surprising part. It's not about picking that one wrong stock. Yeah, that stings for sure, but the most devastating mistake, it's actually something way more fundamental about your whole approach. And this right here, this slide shows you the real culprit. It's not about one bad pick, it's chasing those crazy fast returns. Just look at this. You've got two portfolios that averaged the exact same 5% return over 30 years. But the one that was a total roller coaster ride, that high volatility portfolio, it ended up with $2 million less. $2 million. That is the massive hidden cost of volatility. The slow and steady approach didn't just win, it won by a landslide. Okay, so now that we know the biggest trap to avoid is chasing that wild volatility, let's build ourselves a really solid foundation. We're going to start by decoding some of that Wall Street language so you can walk into this world feeling confident. First up, a stock. It's way simpler than it sounds. When you buy a stock, you are literally buying a tiny, tiny piece of a company. You become a part owner. And if that company does well, hey, the value of your little piece can go up. Next up, a bond. Now for this one, I want you to think of yourself as the bank. You're loaning money to a government or a big company. In return for that loan, they promise to pay you back your money plus interest. They're generally seen as a bit safer than stocks. And that brings us to maybe the most important word of all, diversification. This is your number one weapon against that crazy volatility we just talked about. You know the old saying, don't put all your eggs in one basket? That's it. That's diversification. You spread your money out so if one investment has a bad day, it doesn't sink your entire ship. And this table right here illustrates perfectly why diversification is so key. It shows you the fundamental trade-off between risk and reward. That risk column, that's just a fancy way of saying how much the price swings up and down. A higher number means a wilder ride. So you could see, stocks, yeah, they had great returns, but also some pretty big swings. Bonds, on the other hand, were way calmer, but with lower returns. A properly diversified portfolio lets you find that sweet spot that works for you. Okay, so we've got the basic terms down. Now what? What's a real practical plan you can actually go out and use? Let's talk about a strategy that is absolutely perfect for beginners because it's designed to take all the emotion out of the game. This strategy is called dollar cost averaging, and it comes with a stamp of approval from the legend himself, Benjamin Graham, the guy who literally wrote the book on intelligent investing. When he says something works, you listen. So how does it work? It's almost shockingly simple. 1. You pick a fixed amount of money, say $200. 2. You invest it at a regular time, like the first of every single month. And 3, and this is the most important part, you do it no matter what the market is doing. Up, down, sideways, you just keep investing. By doing that, you automatically end up buying more shares when prices are low and fewer shares when prices are high. It's genius in its simplicity. And look, this isn't just some nice theory. Actual academic research backs this up. It shows that for beginners, disciplined long-term strategies like this one are statistically proven to lead to better results and fewer losses. It's a data-backed way to keep yourself from making those emotional mistakes. So we've got the theory, we've got the strategy, but what does this kind of thinking, this long-term, disciplined approach, what does it actually look like in the real world? Let's check out the story of someone who used these very principles to go from a regular job to complete financial freedom. This is Evan Roberts. Now, Evan didn't start with a six-figure salary or some huge inheritance. What he did have was a clear-cut strategy that was all about acquiring assets that would pay him. His story just goes to show how powerful these core principles are, no matter where you apply them. I mean, just look at the numbers from his first real estate deal. He bought a place, fixed it up, and then refinanced it based on its new, much higher value. The magic here is that he pulled all of his original cash back out to use for the next deal, all while creating a brand new stream of income every single month. That is a powerful, powerful cycle. But, and this is really important, his journey was not a straight shot to the moon. This number right here is just as important as the successful ones. On his very first try at flipping a house, he lost 20 grand. And here's the billion-dollar lesson he took from that loss. He learned something priceless. See, mistakes aren't the end of the road. They are your tuition. Learning from them is what separates the people who succeed from the ones who just give up. It's the most important part of the process. All right, to bring this all home, let's just crystallize everything we've talked about by looking at the most common blunders that trip up new investors. Seriously, just knowing what these are is half the battle. Number 1, following the crowd. Think about the whole GameStop frenzy. By the time you're hearing about a stock on the news and all over social media, you are probably way too late. Don't get caught up in the stampede of hype and fear. Number 2, putting all your eggs in one basket. This goes right back to what we said about diversification. Pouring all your money and all your hopes into one single investment isn't a strategy, my friend. It's a lottery ticket. You're exposing yourself to massive concentration risk. Blunder number 3 is holding on to way too much cash. I get it, it feels safe, but inflation is like a silent thief, just slowly eating away at the value of your dollars. Your money has to be working for you, or it's losing ground. And finally, not doing your own homework. Never, and I mean never, invest your hard-earned money into something you don't truly understand. It doesn't matter if it's a stock or a piece of real estate. You have to put in the work and do your own diligence. So here's the real takeaway. Investing isn't about being some kind of genius. It's about having a good plan and being disciplined enough to stick with it. We've seen that the real enemy